when prices get high enough, if it's coming from the supply side, not the demand side, if it's coming from the supply side, it destroys demand. People will say, let's say you're working and you are filling up your car with gas, and what used to be a $45 fill up is now a $90 fill up. If you have a Ford F-150 truck, because 150 is like $150. That's how much it costs to fill those things up. But demand is inelastic. Like I said, there was the unemployed person, hypothetically, who is home and not using gas. But if you're getting the gas, you need the gas. You got to get to work. You got to do your job. You got to take the kids to school, whatever it may be. Well, if you're spending double, that comes out of something else. Maybe you buy the gas because you have no choice, but then you're not going out for dinner. You're not going to a show. You're not going to a sporting event. You're not buying new clothes. You're not taking a vacation. You quit the club because you can't afford the dues. In other words, it comes out of something else. And that is a depressant on the economy. And that will very quickly be deflationary, particularly when combined with tighter monetary policy. The Fed's reducing its balance sheet, raising interest rate. They're going to keep doing it. They told us that again. Just all you have to do is believe them. It's not that hard to forecast. Debt is nominal. I mean, I focus on the difference between, nominal and real. And a lot of people look at interest rates. They say, interest rates are really low. Well, no, when you subtract inflation, they're actually, real rates are negative. But debt is nominal. If I owe you $1, I owe you $1. It's interesting whether the dollar is worth less because of inflation or more because of deflation. That's important. But I owe you $1. That was the deal. This is where deflation is pure poison when it comes to the debt to GDP ratio I described. Because the national debt is, as I say, it's 31 trillion, but the real value of the debt goes up in deflation. And when I do portfolio analysis for people, I always recommend a heavy slug of cash. And why would I have cash? There's no yield. In a deflationary environment, cash can be your best performing asset, even if you get a low yield, because the real value is going up. Every dollar is worth more in terms of purchasing power in a deflationary environment. So deflation is good for creditors or savers up to a point. I'll come back to that. But it's the worst possible world for debtors, because even if the nominal value of the debt is not going up a lot because interest rates are low, the real value of the debt is going up a lot because the value of the dollar is going up. So you owe more in real terms. Deflation is a central banker's worst nightmare. It's a Treasury Secretary's worst nightmare for the reason I just explained, which is, we have a bad enough debt problem as it is, but if the real value of the debt's going up because of deflation, and you can't borrow your way out of it, what are you going to do? You have to restructure it, or, or you're going to have to create inflation. After creating deflation inadvertently, destroying demand because they're worried about inflation, you may end up in a world where the deflation is so destructive because of the increase in the real value of the debt that you actually have to go create inflation. And that's exactly what happened in Weimar Germany in 1922. Now, one kind of last point with regard to deflation, I said it favors creditors and hurts debtors because the real value of debt is going up, and the creditors like, hey, I own this note and it's worth more. To a point, but at what point does the debtor walk away? What happens is the debtor defaults. So all of a sudden, so it starts out, deflation kicks in, real value of debt's going up, the creditor's happy, the debtor's in distress. But the debtor just says, hey, I'm going to default, file for bankruptcy, you'll sleep in tomorrow, it's on you. So all of a sudden the burden goes from the debtor to the creditor because the debtor just said, I'm not paying. And the creditor has what? A bad debt. You got to write it off, shrink the balance sheet. Now you're the loser. So this is contagion. This is what contagion is. So yeah, the debt's out of control. It's slowing growth. You can't earn your way out of it. There's no reason to default because you do print the money. The real burden gets higher as deflation kicks in. Debtors then default. It's back to the creditor. But assuming the U.S. doesn't default, the only way out for the U.S., the only way out is inflation. We just talked about how we have inflation now. I described how we're heading into a disinflationary or deflationary period, which we are. But longer term, 2025, 2026, you're going to have to go to something that looks more like hyperinflation because it's the only way out. August 2011, the dollar was at an all-time low. And not coincidentally, gold hit an all-time high at the time, $1,900 per ounce. It's gone higher since then, but at the time, so dollar's low, the dollar value of gold is high, all-time high. And people say gold's up or gold's down, and I say, no, gold's not anything. It's metal, it's atomic number 79. What changes is the value of the dollar. When people say gold is up, what they really mean is the dollar is going down, which is the case. Today, we're in the opposite situation, and By the way, gold prices have been coming down. It's down from $2,040 an ounce in early March 2022 to today it's around $1,750, give or take, but it's been as low as $1,650 fairly recently. But that's what you would expect if the dollar is this strong, which it is. So the dollar's not at an all-time high, but it's getting there. It's the highest in over 20 years. You know, people talk about the euro at 98 cents. That's about where it is. I was skiing in the Swiss Alps in French Chamonix on the French-Swiss border in 2000, and the euro was 80 cents. But what happened the last time the dollar was this strong before 2000? Well, it was 1985. That was the Plaza Accord. And James Baker convened the meeting at the Plaza Hotel in New York with the finance ministers of Japan, Germany, UK, France, and Switzerland was there. And they orchestrated the decline of the dollar. The dollar was too strong. It was hurting U.S. exports. It was importing deflation, believe it or not. But by then, the inflation had died out by 1985. It was down to around 2%. So we were importing deflation. They didn't want that. And so the question today is, a strong dollar is doing the same thing. I looked at the markets recently, and what I saw was, stocks were down, bonds were down, gold was down, silver was down, the euro was down, NASDAQ was down, everything was down. And I said, how can that be? I mean, some things go up, how can everything be down? And the answer was the dollar was up. And everything I just described, oil was down also. But everything I just described, oil, copper, gold, stocks, etc., they're all denominated in dollars. So it shouldn't really come as a surprise if the dollar is that strong, that the dollar price of everything else would be lower. And it's a very deflationary trend. And by the way, that's another contributor to the deflation, which will soon replace the inflation that we just talked about. But here's the hard part. Janet Yellen doesn't know anything about this. She doesn't know anything about monetary policy. It turns out she doesn't know much about fiscal policy either. She's running around talking about equity and climate change, so that's fine. There's no James Baker. There's no George Shultz. Where's the leadership and the gravitas and the authority to be what Tim Geithner, and I talked to him about this, he calls it the convening power. Convening power doesn't mean you can force all the solutions, but it does mean you have the authority to convene the meeting, bring a group together and talk about it. So where's the leadership? Where's the convening power to have a new Plaza Accord? Can we stabilize exchange rates? Can we bring the dollar down a little bit? Can we just put gold back in the equation? Maybe not a strict gold standard, but just as some kind of benchmark to help us think about what we're doing independently of other currencies. And by the way, most currency indices, so a DXY, which the Wall Street Journal uses, Bloomberg Index, the Fed has a couple of good indices I use. All of those indices tell you if the dollar is stronger or weaker compared to other currencies. And it's heavily weighted to the euro. And yeah, the euro and the US dollar together are 80% of global reserves. And so that makes some sense, but you're in a bubble. It's currency to currency. What if they're all going down against something else, or they're all going up against something else? What's the something else? And the answer is gold. I mean, that's, you get accused of being a gold bug or whatever, and I don't expect a gold standard anytime soon. So the whole world is suffering from weak currencies, suffering from a strong dollar. The dollar is deflationary from the U.S. perspective because the stuff we buy costs less. We need fewer dollars to buy it all. But it's the opposite for everyone else. In their local currencies, it's highly inflationary, and they're going to start to go broke and default on debt. But the real problem is I don't see any leadership, and I don't see even much awareness of the problem. And finally, I don't see any interest in using a benchmark like gold or even a commodity basket, which the BRICS are talking about as an objective measure